My fellow members of the board, I brought you guys in here to ask, what are we going to do? We have had 26 consecutive quarters of revenue growth. And for this quarter, we are way behind. Our number one vendor, Sports Authority, has gone bankrupt, and all of our other vendors have already placed their orders for this current quarter. I know that my and your stock options depend on our continued revenue growth, and I just bought a yacht. So I'm gonna ask you guys again, what are we going to do?
First thing that comes to mind, I feel like we could be honest with our shareholders, kind of tell them times are tough, we're having vendor issues, and we're not growing like we used to.
Get out. Any other ideas?
Yes, sir, I have one. Might be very beneficial to our situation. We could pressure our vendors to take more products than they currently need for this quarter by incentivizing them with discounts, and then just tell them that they can return those extra products for the following quarter.
But wouldn't that be channel stuffing, and it would hurt us in the future?
I thought I told you to get out. You're done. Now you, I like that idea. My fellow board members, we are once again back in here discussing our issue with our constant revenue growth. We barely scraped by last quarter, thanks to this guy's idea. So I'm gonna ask you guys again, we got any ideas?
Well, considering we pulled forward last quarter and it's not super sustainable, we should probably cut our losses and inform our investors of our revenue shortfall.
Who do you think we are? Puma? That was a serious question.
No sir, I do not think we are Puma.
Get out. We got any other ideas?
Hey, Mr. CEO, Kevin A. Plank, the honorable one and only. I have an idea. What if, I know, crazy, insane, but what if we pulled next quarter's sales into this one? Hey, here.
This man's getting a raise.
Yes!
Let's go.
Yes!
Does anybody know what to do with this freaking revenue growth? We are down. It's not working. I'm a loss for ideas. I had to use my first yacht as collateral for my second yacht. Does anyone have any ideas?
I think I may have mentioned this before, but we're kind of signing up for bad news if we continue to lie to our investors about our revenue. We should probably leave the books as is and end our revenue growth streak.
Hey, pal. Our great and honorable CEO, Kevin Plank, has given us this blessing of 26 plus quarters of 20+% revenue growth. And you really want to question him? He has 2 yachts. How many do you have? Actually, don't answer. I don't care. Hey, Kevin, I have a great idea.
We hope you enjoyed our comedical reenactment. Now let's dive into the nitty-gritty of it all.
All right, Under Armour manipulated its financial statements by pulling forward a cumulative $408 million in sales from future quarters into earlier quarters. They recorded revenue early by convincing customers to accept shipments ahead of schedule by offering discounts and extending payment terms. This is technically allowed under GAAP, but the failure to disclose their strategy is misleading to investors as their future quarters have worse financial health than stated. All right, so for the journal entries they made were the standard sales entry, debit accounts receivable, credit sales revenue, debit cost of goods sold, credit inventory, debit sales returns, allowances, markdowns, and discounts, and credit reserves for returns, allowances, markdowns, and discounts. On the whiteboard here, we have what they should have done in quarter 1 of 16, and then what they did in quarter 4 of 15, pulling the revenue from the future quarter into the previous quarter. The difference here is that they have an increase in the sales returns and reserve. And this increase is because the customer incentives offer discounts and extended payment terms, requiring a bigger allowance.
Senior management in their FP&A, their financial planning and analysis group, conspired to increase revenue growth in quarter 3 of 2015 through quarter 4 of 2016 to meet analyst expectations and continue their streak of 26 consecutive quarters of 20+% revenue growth. This was important to them because as of 2015, there were 1,151 record holders of Class A common stock and 5 record holders of Class B convertible common stock, which were beneficially owned by their Chief Executive Officer and Chairman of the Board, Kevin A. Plank. Not only this, they also had around 5 million restricted stock units and deferred stock units issued to employees, non-employees, and directors of Under Armour. Not meeting these analyst expectations stood to tank the stock price, as evidenced by when they didn't meet expectations in quarter 1 of 2017. The price ended up dropping by 23%. They didn't want that to happen. They wanted their money to keep going.
So the auditors of Under Armour should have seen this coming, or at the very least seen the potential for this to happen. There's a few auditing standards that I think if the silly auditors reviewed, that maybe they'd be able to catch this one a little bit earlier. Example of which is auditing standard 2110.10, which covers that auditors should obtain information for identifying and assessing the risk of material misstatement of financial statements associated with the company's financial relationship and the transactions with its executive officers. So basically, the executives and employees Under Armour are going to be gaining from the company doing well. So that right there, that should be an immediate potential for fraud risk. Another example, which is AS 4201, which goes into this as well. In the appendix, it literally lists almost exactly like the scenario we have, which is significant portions of their compensation, for example, bonuses, stock options, and earnout arrangements being contingent upon achieving aggressive targets for their stock price, operating results, financial position, or cash flow. So basically, that's kind of word for word what happened. So if the auditors reviewed this, they might be able to catch that. So another standard that auditors should look into in the case of Under Armour would be standard AS 2401.66, which is evaluating whether the business purpose for significant transactions that are outside the normal course of business for the company or that would otherwise appear to be unusual due to their timing, size, or nature. So these are also known as significant unusual transactions. So in the case of Under Armour, we have several of those. They should be showing up near the end of the quarter for that would otherwise be future sales. We're now using them currently. They're trying to boost their revenue by the end of the quarter. So these transactions that we would see should be investigated further and verified to make sure that they are in the period they should be.
So leapfrogging right off of Miles' wonderful explanation of auditing standards that auditors should be paying better attention to, I would like to highlight one major change that we believe should be made. AS 2401.66 states, evaluating whether the business purpose for significant unusual transactions indicates that the transactions may have been entered into engaging fraud. Significant transactions that are outside the normal course of business for the company or that otherwise appear to be unusual due to the timing, size, or nature, significant unusual transactions, may be used to engage in fraudulent financial reporting or conceal misappropriations of assets. We are changing this to be more specific by adding in transactions that occur earlier than would normally be expected, such as large purchases or sales that are inconsistent with the company's typical operating cycle, should be investigated to determine whether they serve a legitimate business need or may indicate potential fraud. We believe that this better highlights channel stuffing. While not technically fraudulent under GAAP, it is still misleading to investors and something that should be taken into consideration when auditing a company.
Thanks for watching our depiction on how Under Armour misstated their revenue for 6 straight quarters.
Let this serve as an example for auditors to remain diligent and professionally skeptic. Just because a company is massive doesn't mean fraud can't occur. If it seems too good to be true, it probably is.
Under Armour ultimately ended up paying a settlement to their investors of $434 million, which is worth approximately 21,700,000 racks of Bush Apple or 15,308 Toyota Priuses.
Always remember that fraud is like a fart, silent but deadly.
Thank you.
Thank you.